Asset TV. We got the mugs, but we've got the brains here with Christopher C. Davis, portfolio manager and chairman of Davis Advisors, talking risk in 2017. This whole moment here is about risk and the outlook you have for it. What do you see on the horizon?
Well, I always think when people want a forecast of the market, of interest rates, of the economy, of the political outlook, the data is overwhelming that these forecasts have no predictive value. It's just, people are paid to give forecasts because they're asked, or they give answers because they're asked to,
right.
But they don't know. And so what we always say is those things are important, but they're unknowable. So what we try to do when we think about risk in this environment is we think about what we can know. And what we can know is, starting today, stocks are at a reasonable valuation. Not a barn-burning price, not a bubble, but they're in a reasonable valuation, especially compared to the alternatives. Okay. And usually the biggest risks are where people feel safest, not where they feel nervous. And certainly investors today have this sense of nervousness still in stocks.
Although we keep hitting record highs. I think that the NASDAQ's had something like 5 in a row. Today, I think the market's slightly colored red, but and we're bumping up against Dow 20,000. And yet it does still feel, to your point, like people are still very nervous. Isn't there a lot of money on the sidelines?
Well, the market climbs a wall of worry. And yes, there is a lot of money on the sidelines. I think people have come to recognize that the greatest danger is usually where they feel safest. Okay. So they feel safe in bonds because they haven't lost money in 40 years. And that could just be starting to unwind.
They're barely making money now.
They're barely making money now. And you know, my grandfather called bonds certificates of confiscation, because he said you could lose money for decade after decade after decade. Right. In stocks, you own businesses. The businesses build value over time. Now, I think it's a little bit of a dangerous time to be a blind index investor. I think there are lots of reasons that the average company could face headwinds. I don't think there's excessive valuation, but there always are risks. When we look through at individual sectors, where do people feel nervous? Look at financial stocks. Look at global stocks. These are areas where we really think as stock pickers there's opportunity. There's usually opportunity where people feel nervous, right. and there's risk where people feel safe.
Well, that does go to the Warren Buffett theory of going in, you know, the areas that people are most terrified of. But sometimes that can hurt you. Although, look, the oil trade was certainly interesting, just as things got really, really bad. I think next week we will have doubled from a year ago.
Yeah,
next
well,
week
and look at
double.
financials. I mean, even now people feel frightened of financials. The crisis is scarred into their minds, and yet, you know, financials in aggregate are in a better capitalized position with less competition, many of them under earning because of low interest rates that could go up and increase their earnings. So I think there are still real opportunities out there, but the risk is usually where people feel safe.
I know we're sitting here talking about Asset TV, Outlook 2017, but could you give us maybe 3 things that investors should be looking and thinking about for the next decade?
Well, that's the perfect time horizon. There, I feel a lot more on safe ground than trying to predict interest rates in the next 6 months or the market in the next year. You know, of course, there can be corrections and so on in the short term, and it's just the wrong time frame to focus on. So you're right, over a decade. Well, number one is that the best time to get started investing is when you have the money. You know, Peter Lynch said, more money has been lost predicting and preparing for corrections than in corrections. Mm-hmm. And so we think the most important thing is, instead of trying to time the market, to get started. You know, often a systematic plan is best, when people just put a little bit aside every month or every quarter in a disciplined way. So I'd say that's the number one. Number two,
dollar cost averaging.
Exactly. And number 2 is that the number one enemy to investor returns is investor behavior. It's just that people get
second guessing.
It's second guessing. It's feeling better as prices go up, feeling scared when prices go down. You know, it's firing managers after periods of underperformance, but chasing performance after good periods. We think that it's really important to try to manage the investor behavior. That is, that more money is destroyed by investor behavior than underperformance or outperformance. And I think the third thing is, and this is a little contrary in a time when people love passive and love indexes, we're at a time of unprecedented upheaval in terms of technology, obsolescence, political turmoil. I think you need to leave room in your portfolio for for managers that can adapt, that can use judgment and experience and respond to changing times.
Well, look, the perfect example, we've got Donald Trump taking on companies that move operations overseas. Now, I've heard a lot of people, because I just came from the Consumer Electronics Show in Las Vegas, say, fine, he can force Ford and he can force Carrier to come back and say, okay, fine, we'll stay in the US. But down the road, that may mean robotic plants. They're known as dark factories, where there's little or no human intervention. So you figure out a way to make that trade. It sounds a little cold, and it is. It's upsetting because the future of the American worker is very much in question. I don't know how you catch the wind of that and figure out how to invest around and through that.
Well, I just sent our research team a wonderful essay that coined the phrase technological unemployment. And it's this wonderful phrase, and it says, the pace of innovation has been so fast that workers haven't been able to keep up, and therefore we may enter an era of systematic low investment. That paper was written by Keynes in 1930.
Come on, really?
Absolutely. It's a spectacular paper called The Outlook for Our Grandchildren. And so this is nothing new. The Industrial Revolution saw this, or these periods of catch-up. I was visiting an Amazon distribution center recently, and there were 6,000 or 8,000 employees in there. Amazon just announced today they're going to be hiring another 100,000 people. So there is growth. There's huge growth in healthcare. And I think what matters, and this is the sort of the case for active management, for experience and judgment, is the ability to adapt. I think putting investing into a sort of a robotic form, passively just owning whatever's the largest, I think that's more at risk in a world of change. So I think that there's a case for active management, there's a case for stock selectivity going ahead, and there's a case for avoiding those areas where people feel safe.
I think you missed your calling. You should be a psychologist or a psychiatrist to talk people off the ledge, because we all feel very overwhelmed at this point. And when you're trying to make money decisions, just as ISIS somehow takes a new stronghold, or there are new elections where the outcome is a complete surprise, or something like Brexit, there is that inclination to hunker down and to go where you feel safest, and you say that's the most dangerous.
Yeah, you look at dividend producing stocks. People feel safe with high dividends. They don't look through at the businesses. And I think that idea of recognizing that the cure for fear is knowledge. And so the more you understand what you own, the more you have confidence in the manager making your investment decisions or in the businesses underneath that, the more you can invest with confidence through turbulent times.
Dr. Davis, I'm now making you Dr. Davis. Chris Davis, it's wonderful to have you. Chairman of Davis Advisors. Your grandfather Shelby and your dad would be very proud.
Thank you so much, Liz.
Good to have you.